This is Nick here and about to go through the updated Federal Reserve chart book ahead of today's meeting on Thursday, November 8th. So looking at the Fed funds rate here historically in black, the Fed did hike at their September meeting to 2.25%. Their estimate of the normal longer run rate is at 3%, so they're still below that, which in Powell's framework represents an accommodative stance, with this being sort of the neutral stance here at 3%. And the Fed has indicated, many Fed speakers, including Powell, have indicated that they may have to hike above this neutral rate to actually put policy into a I guess you could say a restrictive stance, as opposed to this current accommodative stance. Powell at the press conference in September was asked about, given the lags of monetary policy, how he thinks about ending the tightening cycle. And he talked about how gradually raising rates allows the Fed to monitor how the market and the economy are reacting to those rate hikes, and that the fact that they're moving so gradually kind of limits this problem of the lags. And you can read the quote there to understand that a little bit better. That's just sort of a zoom in terms of the timeline on the previous chart. Then looking at the estimate of the natural real rate of interest, so this is sometimes referred to as the R star. It's a very academic term, but the idea is that what is the real natural or neutral rate of interest, in other words, net of inflation. And so some of these estimates seem to be around, between 0.5% and 1%. And so if you think that's the kind of the natural real rate, then with the inflation rate running at 2% and the long-term target at 2% and the Fed's inflation expectations at 2%, you would add 1% plus 2% gets you to a nominal rate, natural rate of 3%, which is essentially, I think, how they're arriving at this 3% estimate here. In terms of what's priced in 1 year out, so the Fed funds effective rate is expected to be, according to market pricing, based on the Fed funds futures contracts, at 2.87%, basically. So further rate hikes still expected and priced into the market. This is another way of looking at Fed rate hikes. This is the percentage points of Fed rate hikes priced for this year and next year. So pricing in about 6 hikes for this year and next year, 3 of which have already been done at the March, June, and September meetings, and market expecting pretty high probability for a December rate hike this year from the Fed, to do a total of 4 this year. Then looking at the inflation readings, so both readings right on the target at 2.0%. And I think Powell is more focused on the core reading. He views that as a better indication of inflation dynamics and pressure and what the future inflation rate might be. The Fed looks at market-based inflation expectations. So one of those is the 10-year break-even rate. This takes basically subtracts the 10-year TIPS yield, which is the real rate, from the 10-year U.S. Treasury yield, which is the nominal rate, and that's at 2.1% right now. So pretty close to their target of 2%, which is the dotted line here. Then Powell has commented recently that he really focuses a lot on these survey-based inflation expectations as well, which have been very stable over the past 10 years, as you can see here. And I've got the relevant quote there in the box. And basically Powell looking for any material changes in those survey-based inflation expectations, so something that we are monitoring as well. Then this chart deals with the Phillips curve, so the unemployment rate and wages. You can finally see we're really starting to see the wage inflation pick up here at 3.2% year over year. You can see late cycle, it does tend to converge towards that U3 rate, which is the unemployment rate, which remains stable at 3.7%. Then looking at these unemployment rate measures, as I said, we were stable at 3.7% on the U3 rate. Then we have the U5 and the U6. And you can read the description of those in Powell's words here in the quote box. But in any case, the unemployment rates are looking pretty strong, as is the job gains, so the net monthly change in non-farm payrolls, which are the gray bars, with the 3-month moving average being the black line. So 218,000 is the 3-month moving average. That's pretty much in the middle of the range here, going back many years, and as Powell notes, is above the pace needed to provide jobs to new entrants into the labor force. Then the JOLTS report, the job openings and labor turnover survey. This was one that Yellen really focused on, and I think it's a worthwhile economic data set to monitor. We just got the updated data here for September. So at 2.4% for the quit rate, that is a very strong reading. And then 7.01 million on the job openings. So a lot of job openings. That was a little bit of a downtick from the prior month's data, but still very strong, and these look like they're still trending up. So labor market looks very strong. Then a prime age labor force participation rate, so an uptick here, which is a healthy sign. I think Powell is looking for maybe this to get all the way back to where it was at the prior cycle peak, maybe around 83%. Still got a little ways to go. I think Powell does view this as an indicator that there's still some slack left in the labor market. Then Powell has commented specifically on the male labor force participation rate, which in some ways provides a better gauge on the long-term picture here. And I think there's a relevant quote here in the quote box that you can take a look at. But in any case, we did see an uptick here on the last jobs report from last week. That seems to be kind of, forming this this uptrend here over the past few years, and I've drawn this just subjective trend line here, dotted line showing the long-term decline, and you can see that as we get towards that dotted line, we've that potentially represents a complete reduction or elimination of labor market slack. Then looking at the financial conditions, these remain very accommodative, not quite at the absolute lows as of the last week's report, but still very, very accommodative. So the Fed has been hiking rates, trying to tighten financial conditions, but real-world financial conditions have not really responded to that, in part, I think, because banks have eased their lending standards, which I commented on in the business cycle report. Then on the dollar, Powell not really too concerned about the dollar. He did get a question on it and provided the comment there in the quote box. But as you can see, kind of in the middle of this long-term range here in terms of the U.S. dollar index. Then on the Fed's balance sheet, that continues. So they've actually, that was announced in September of 2017, starting October in the beginning of Q4 of 2017, and it had this gradual increase in terms of the pace of normalization, and now over 12 months later, as of October, the beginning of Q4 2018, that's now at the full run rate for the pace of normalization. And I think that will continue to represent tightening of monetary policy as that is basically set on autopilot. Then in terms of the Fed dot plot, so really no changes from the June report. You can see, the median projection here on the FOMC, pretty unanimous. Not quite, but obviously a strong tendency here to expect 4 rate hikes this year, which would suggest a December rate hike and then 3 rate hikes next year. The market's still not quite pricing that many. Market's pricing about 2 rate hikes for next year. These are the other summary of economic projection numbers, which you can take a look at on the PDF. The who's who at the Fed, just to keep track of all these various names as they come out with public remarks and comments. And then you can read the conclusion and thoughts here on the PDF. But I do think Powell is committed to a gradual approach and will, I think, likely go ahead with a rate hike in December and remain data dependent, looking at the incoming data as it becomes available.